Right guys, so in today's video, I'm going to take you through a liquidity sweep, simplistic liquidity sweep ICT strategy, all based on sweeps of liquidity and pairing this with time, macros, or silver bullet. If you want this PDF, I'm going to upload this in my free Discord, so check out the link in the description of this video. All my other recent videos that have PDFs, the free PDF is in that Discord. So I've got a free and a paid section. This is all for free. Now, what I want to talk about firstly is how do I use liquidity sweeps? And really I want to discuss how you guys can also effectively use liquidity sweeps, because it's the basis, right? It's the basis of pretty much all trading strategies. Either you're going to be targeting liquidity or you're going to wait for liquidity to be swept. So you need to understand what liquidity is, its function, but also the different forms of liquidity. And then more so, once you understand that, how to execute and build a model, build a strategy around this. And the idea for today is to give you a model, and then you can use that and forward test that, back test that. But I want to give you a high probability or a high chance model that you can use. And this is from my own data collection and things you've probably seen yourself. So the aim of this video, the PDF, just to illustrate the high probability trade ideas based on liquidity sweeps. And I want to give you a few examples, not just one, not two, but a few examples of how you can build a model around sweep and liquidity. Most people know, if you're from my YouTube channel and you've been here for a while, my name's Ruben and I trade mainly the London session. If you're new here, welcome to the channel. I do have experience trading all sessions, right? So at the moment I trade the Asian, the London session, and a little bit of PM, but I have traded the AM session before, all sessions, and I simply just trade NASDAQ. Most models, including my own, and I've got a few models that I like to use, they do require some kind of sweep of liquidity, and that's what we're going to be discussing today. Firstly, I want to break down what is liquidity. For anyone that's new, have a look at this, and even if you've got experience, going back over the basics is a really good thing to refresh the memory. But to put simply, liquidity equals money. That's the way I like to see it. So when I'm learning ICT concepts, or I'm trying to apply the concept, in my head, I'm trying to make it as easy to understand, as easy to apply. And that way I'm going to be confident in the market, applying that edge and applying that model or strategy. Liquidity either rests at swing highs and swing lows, either one. So I've marked out, some swing highs here with blue and some swing lows in red. That is where liquidity rests. Now, what is liquidity? Liquidity is where people, for example, have their stop loss. In the market, when it's trending up like this, say for example people are taking longs and they're holding trades for quite a long time, most people are going to trail their stop loss beneath these swing lows. At the same time, there's people that were going short from here and they're going to be trailing their stop losses down above their swing highs. Therefore, there's always liquidity and the market's going to move to either the upside or the downside. We're going to base a model to target either side, either buy side or sell side, in any session. Could be London, Asian, New York, AM or PM. So that's what I like to see liquidity as. And the market only targets two things. The market only targets liquidity at swing highs and swing lows, and also imbalances in the form of fair value gaps. Therefore, and this is what I'm going to say, therefore, if you haven't watched my previous video, check that out. It's all about how I like to use fair value gaps. The one before that is how I like to use inversions. Pairing those two videos with this video here is going to completely open your eyes. If you want a model, you want something that repeats, because you're going to be using the two things based on ICT principles that the market moves for: liquidity and imbalances. So in the image to the right, I've marked out all those things, but let's just get to the next example, because I want to talk about the importance of stacked liquidity, the importance of relative equal highs, relative equal lows, and also what is good liquidity. Like, what makes liquidity good, what makes liquidity bad, what's the good liquidity to target, what isn't so much, and when can you expect a quick move. Now that we've discussed the basic principles, I just want to extend on the topic, call it stacked liquidity, call it good liquidity. So whenever you have relative equal highs, relative equal lows, that's always going to be great. Why? Because you've got people that trade support and resistance, and their stop losses are going to go either above the highs or below the lows. The second form of good, or you could call it stacked liquidity, is trendline liquidity. And what you're looking for is price to be stuck in a very tight, narrow range, just like this, tight, narrow range, and be grinding. And you can see what happens at price. We aggressively sweep that liquidity. So price will often move aggressively to stacked liquidity that can rest above equal highs, equal lows, or below equal lows, or trendline liquidity. Because different types of traders, right, trade support resistance. Other traders, trade trendline liquidity. And these are things that we like to target, right? I like to call this low resistance. So if you hear people talk about LRL or trendline liquidity, this is what they're talking about. Low resistance liquidity for me, or low resistance liquidity run, just means that the price, you expect it to move quickly because there's a lot of stacked liquidity. So the idea of low resistance is the market's going to move quickly to these liquidity points, to these swing highs or swing lows, because liquidity is stacked, because stop losses are stacked. And think of it as money and energy. The market, or a magnet, right? It's a magnet for price. It's a really strong magnet. These forms of liquidity are really strong, and therefore the market should pull to those really quickly and really fast and really strong. Because of that, if you can build a model based on this and use these principles, you're going to be in good hands, right? So we've talked about stacked liquidity, we've talked about the basics, but what makes a good liquidity sweep? If we're going to build a strategy about liquidity, we need to understand what it is, the different forms, the good forms we want to target. But what makes a good liquidity sweep? And this is the question that people ask me all the time. So for me, there's a few factors that need to be unpacked here. And the first question I'll always ask myself, whenever we sweep a swing high or swing low, and we're in a key time frame, I ask myself, does price reject after sweeping the high or low, or does price push through it? So if it's truly a liquidity sweep, it's in the word, a sweep. A sweep is not a push through, it's a sweep. So you want to come up and then come back down. Price should reject after sweeping that high or low. It shouldn't just push straight through and then close aggressively. If it ever does that, if you're looking at the market and say this example here, this is a good liquidity sweep because we pierce through these relative equal highs and then we reject. That is a good liquidity sweep. If this candle closed up here on a higher time frame and up here, my assumption is that this is not the liquidity the market wants to target, and I'm looking on this side of the curve a little bit furthermore to see what other liquidity is there on a higher time frame. And that's how you prevent yourself from getting tricked. Is it a market structure shift? Are we continuing moving up? Are we going to reverse here? I like to use those principles, just the basic stuff. Is price rejecting or is price pushing through? And that'll really clear up a lot of things for you and negate a lot of silly ideas or silly trades. That's just my opinion. So you can see in the example below, after sweeping buy side, price rejects. The first chart's on the 5 minute, this is the 5 minute, and this second chart here is on the 1 minute time frame. So you can start on a higher time frame, a 5 minute, a 15 minute chart, or have both side by side depending on what you like to do. And then once you see liquidity swept on a 15 minute time frame, this is what you're looking for. During a key time frame, silver bullet, or during a macro, any macro within silver bullet, any macro within London Open, 2 a.m. to 5 a.m., any macro within the AM session, whatever it might be, or PM session, whatever you trade, look for that, look for a sweep, and then drop down to a small time frame to see, okay, we swept liquidity, and do we reject? We do. What do? We form this inversion fair value gap. Price is probably going to move lower. Where to? To the next swing low. And this will implement the strategy I've talked about in the previous videos, talking about how to use fair value gaps and inversion fair value gaps to kind of get a narrative or get a bias for the session. The next question is, how do I have confidence in the liquidity sweep? The answer is time and price, because you might say to me, well Ruben, yeah, we've swept this high, we've rejected on the 1 minute, but how do you have confidence that we're not just going to continue back up again? And this all comes from the idea of time and price. So you have to understand that, a sweep of liquidity, it means nothing. For me anyway, it means nothing if we're not in a key time. It also means nothing if there's nothing to target. So you're waiting for the sweep on the 15 minute or on a 5 minute, right? Depending how small time frame you want to trade on. You're looking for price to be in a key time frame in a session, London Open session, for example, or a macro or silver bullet. And then you're asking yourself, do I have liquidity to target? Is there something clear to target on the opposing side? So a liquidity sweep strategy, in this case, I'm talking about a reversal strategy, but it applies for a trending market too. And if you want a video about trending markets, let me know. I'm happy to make one. So we can trust in a sweep by observing the initial rejection and then pairing this with time, PDRAs, and then a clear draw on liquidity. So you can see the sweep there. We've got the start of London Open session here. So we're looking for trades. We've been trending up all session previously in the Asian session. It's due for a pullback, right? Now, putting the pieces together, this is the same image here. This is the same sweep of the buy side liquidity. Number one, we've swept a swing high and we've rejected. Beautiful. Number two, we are in the London Open session. That's the time element. Now let's explore the price elements that extend onto that. We talked about trendline liquidity. This is the importance, right? We talked about stacked liquidity. Notice we've got relative equal lows and trendline liquidity here. That's stacked. It's pulling the price like a magnet. It's pulling it. And you're pairing this now with what we've previously done. So you start off with the sweep, then you drop down to a small time frame. You make sure you're in a key area or key time in, silver bullet, London Open, and then you target liquidity that's stacked. Simple as that. This will occur time and time again. It's not 100%, but there's a high probability that's going to work out if you pair these confluences together. So for the elements of price, let us focus on the PD arrays that we've created after the sweep, and also the liquidity we can use to target. Now, what I've said here is notice that after the sweep, we create that nice inversion fair value gap. Really nice. Nice big displacement inversion directly after the sweep. That's important. Remember I talked about how when we sweep liquidity, you don't want to just push straight through. You want price to react after sweeping it. That is beautiful. That is beautiful. And one little note, if you're still here, right? Just observe price. If you ever have relative equal highs, relative equal lows, this is a little gem. Just observe price, because a lot of the time when you sweep those, it's going to react very quickly. Same with previous day highs, previous day lows. A little tip for you. And I might make a little model or video on that a bit later on. So we create the inversion. That's the initial price element. The inversion fair value gap, that is an entry model. So you can enter, right from here, put your stop above the high. You can use a turtle soup, but we've got a clear drawn liquidity. So the actual PD arrays you enter from, that's up to you. The number of PD arrays you need, that's up to you. Now also, what are these down close candles? That's a breaker. When we close below, we form a breaker. So if you enter here, you've got a breaker, you've got an inversion, and you've got that nice sweep of liquidity to support your price action or support your trade, realistically. And you've got trend line liquidity. You've got all the elements you need to, target and have a nice trade. So notice here how, like, when we use price signatures and we mix this with time, it's just one way to use liquidity. And this is the model. This is the model. It's not necessarily the 2022 model because you're using an inversion, but could you use a fair value gap here? Of course. Like, if price inverted this, created a bearish gap and then traded back into it, you could then go short. What would that be? That would be the unicorn model, because you've got a breaker block lined up with a fair value gap. So the PD arrays you enter from don't matter too much, in my opinion. What matters is what happens before. So what happens before is you've swept liquidity, you've reacted after doing so during a key time frame. Do you have a clear target? How you enter doesn't really matter. You can enter off a turtle soup if you're that confident that price is going to react from there, or wait for a rejection candle. That's completely up to you. And everyone's going to have a different idea of how that kind of works and how that makes sense for them. Now, this occurs in all sessions. So let me just go through a further illustration. That's from the London session, the London Open session. So that's 2 o'clock in the morning, New York time. Further illustration here. Let's look at the New York session, but also just like later times. So later in the London session. Now, let's ask ourselves the same question. When we sweep sell side liquidity, ask yourself, do we reject or do we push through? Let's have a look at this example here. That is sell side liquidity. Do we reject or do we push through? We reject. Cool. That's the first element we're ticking off, right? Second thing, we're putting more focus into the chart. So what I like to do is I like to ask myself, okay, what has price done? And you see how we form this trend line liquidity here, and then we have this impulsive move down. That's manipulation, because that's or accumulation there, manipulation down, we sweep sell side, and then I just see, okay, do we react? If we react, then I'll make sure we're in a key time frame. In this case, if you see the bottom of the chart here, you can see that the time frame we're looking at is a macro. So that's 9 o'clock, 8:50 to 9:10. Every single hour there's a macro. Every single hour, right? And this is the last macro. It's a good one because it's the last macro before the 9:30 opening bell. So sometimes if you can catch a trade in this macro, the 9:30 opening, what's it do? The 9:30 opening pushes price in the direction you've already entered. And this is how sometimes you get really nice banger trades using just a simple liquidity sweep. We swept liquidity, we stall, we don't push forward, we don't push down anymore. We come up in here, we form an order block, which is this down close candle. When we close above, that's your entry, bang. Stop loss below these bodies. Where do you target? You don't have to target all this trend line liquidity, but you can. And that's the 9:30 candle there. The 9:30 candle delivers the damage. So this is just a further example of how you can use price, time, but a liquidity sweep strategy. It's not any sell side, any buy side. It's a matter of understanding what stacked liquidity is, because stacked liquidity is what you want to target. Once you know what your target is, then you can wait for liquidity to be swept during a macro or during silver bullet or during London Open session. And then all you're looking for is for price to show you that it doesn't want to go any lower or doesn't want to go any higher. In this case, it stalls. We sweep the sell side, then we react. Again, guys, if you like this video, let me know. This PDF is for free. It's going to be in the link in the description of this video. Let me know. Any suggestions, let me know. I've got a few ideas, a few videos coming up, which is really cool. But again, the Discord's free. If you have any questions, let me know. That'll be in the Discord, this PDF. I encourage you to backtest this, but more so forward and live test this, because you're going to see it apply every day, all session, right? Asian, London, New York, AM, PM. And this is just one of many strategies I use, one of many models. You know, start with this one. If you're new to trading, if you're, you know, first timer to this channel, welcome, and start with this. Start with something that you can apply and collect data, guys. Collect data on these ideas to see when they work, when they don't work, and how often they work. Hope you guys enjoy this video, and until next time, peace. I'll catch you then.